Hello and welcome to another episode of Perspectives. I'm Phil Gioia, Client Portfolio Manager here at DoubleLine, and today I'm joined by a very special guest, Andrew Hsu, Portfolio Manager of many DoubleLine strategies and the head of our asset-backed securities team. Andrew, thanks for running the show today.
Yeah, thanks for having me.
The topic of today's episode is going to be on the securitization process. So to start, perhaps we can talk about an equation that most investors will probably know, regardless of their sophistication level within the securitized markets.
Yeah, so the way I think about securitized markets, often people talk about it not being transparent. And I would actually argue against that. I'd say actually it's one of the most transparent investments that you can have. And the formula that you're referring to is really the balance sheet. I really think of all investments as part of the balance sheet. And in accounting 101, the first equation I learned was assets equals liabilities plus equities. That's the formula for the balance sheet. And under every scenario, it needs a balance.
So when you think about the, securitization process, how does that balance sheet look when you break out the assets and liabilities and the equity?
Yeah, sure. And I like to compare it against the corporate market because everyone's familiar with the corporate market. When you start talking about securitized, I would say that the knowledge base is a little bit thinner. It's just not something that everyone learns.
Mm-hmm.
In a corporate investment, corporate bonds, for example, you're invested in the liability side of the balance sheet. There are assets essentially that support the liabilities and the equities within a corporate balance sheet. And if you look at that and juxtapose it against securitized products, I would say that a securitized asset is essentially just a fixed balance sheet. You have assets that drive the liabilities, which are essentially the debt tranches. And then there's a structured equity position at the end. Sometimes it's retained by the originator. Sometimes it's also investable asset class.
One thing I hear from investors sometimes is the transparency into the corporate market and the perception of the lack of transparency in the securitized markets. So can you maybe talk a little bit about the, transparency and maybe that false narrative that securitized markets aren't transparent?
If you think about a corporate investment, so let's just use corporate bonds as an example. You're invested in the liability side of the balance sheet. Now, with a corporation, and let's just use Amazon as an example, they have inventory. When they first started their business, their inventory is books. Today, their inventory is anything you want to buy. They also have Amazon Web Services, part of their balance sheet, which is data centers and such. And that certainly did not exist when Amazon first started. So that balance sheet has changed. The asset side has changed. They had to increase the liabilities to finance all these different acquisitions of assets. And then the equity, they've issued more equity along the way. So the entire balance sheet has changed. Now with a securitized asset, that asset base is what you get on day one. So whether it's mortgages, whether it's data centers or anything else, we know exactly what the underlying assets are, and it cannot change for the life of the transaction. The liabilities and the equity, they're also fixed. They cannot change for the life of the transaction. So anytime somebody suggests that securitized assets are not transparent, I do give them that example because I do think it's one of the most transparent assets you can find.
Yeah, so a corporate asset mix can shift through time depending on, buying and selling different assets. You gave the, Amazon example starting as a bookstore. Now they're, Jeff Bezos is in space. Yeah. So, a lot of change through time. But you also did mention data centers, and that's been a very big topic, right? We've written a few white papers on this topic, data centers and kind of the AI revolution. But maybe you can talk a little bit about now. So if we look at data centers as it relates to securitization, maybe give an example of what that balance sheet, right, the assets equal liabilities plus equities, would look like for a data center securitization.
So we'll do something that everyone's talking about today is the infrastructure around the build out with AI technology, and that is the data center. So let's use the data center as an example. And if we look at the balance sheet, there's an asset, but then there's it has to equate to the liabilities plus the equities. In this illustration that we have, the asset side will be the data centers and all the cash flows that are generated off those data centers. The liabilities will be the debt. And then you have the equity position in yellow. When you're investing in securitized debt, we're really talking about the blue and the tan positions.
Okay, so, as a securitized investor, right, there's a lot of things you can consider, right? Things like credit quality, and typically the higher up in the capital structure you are, right, the more safety you have, right? Because we often refer to it as a waterfall structure. So maybe talk a little bit about the, positioning on the capital structure as it relates to the liabilities.
Sure. So in the example that we're talking about, there are cash flows that are generated off the assets, in this case, data centers. They flow top down from to the liability and the equity side. So The senior most tranche in here, this example is AAA. It will receive cash flow first. Once that's satisfied, then it goes to the BBB tranche, and any excess cash flow goes to the equity. So the safest asset in this structure will be the AAA asset, and then it goes to the BBB. So you should expect the lowest yield at the AAA because it's the safest, the highest yield on the debt tranche, the BBB debt tranche because it's essentially lower in the capital stack, and then the highest return in the equity. I will point out one thing, because this equation, the balance sheet always needs to balance. If there are losses for any reason on the asset side, you need to take losses on the liability plus equity side. Losses flow bottom up. So the equity would get impacted first, and if it's severe enough, then the junior most debt, in this illustration, the BBB.
So similar to corporates in the sense that you have the ratings, right? And generally speaking, a AAA rating will be more safe or safer than a double B or single B rating, but a little bit different in the fact that it's that waterfall structure, right? So you're protected in the fact that, losses occur from the bottom up, whereas corporates, it might be a little bit more binary, right? If a company defaults, you may or may not get your money back. Similar to securitization, but you have a little bit more of that, protection because of the waterfall structure.
That's absolutely right.
So we talked about the credit tranching, right? There's also time tranching, and a lot of that is due to or is inherent in the mortgage market. Can you talk a little bit about how the assets equal liabilities plus equity equation works if we're looking at mortgages?
So how it would work in time tranching is we're using a different example here, and we're using residential mortgages as our asset, and then our liabilities. There's 3 debt tranches here, and we're breaking them out into a short duration, intermediate duration, and long duration. So investors, while they may have interest in different parts of the credit spectrum, so the previous example was AAA and BBB. In this case, investors may have different needs in terms of duration spectrum investments that they want to essentially acquire. By time tranching, the senior most tranche gets cash flow first. It's going to have the shortest duration. Once that tranche is paid off, then the next tranche, the intermediate duration tranche, gets paid, and then finally the longer duration tranche. So in this case, rather than credit tranching, we're essentially tranching for duration, and this gives investors a different spectrum of duration profiles they can access.
Yeah, the last episode I did was with our insurance wholesaler, Paul Schroeder, and we talked a lot about how insurance companies, they have to match their, liability needs with different investment profiles. And, a lot of what we talked about was around the time tranching, right? If you have I think it was PNC was the example that had very short duration liabilities, right? They would probably invest in the front pay or the short duration mortgages. And then you have something like a life insurance company that has much longer dated liabilities. They would likely look for the longer duration cash flows.
Yeah, it gives investors options basically everywhere.
Yeah, more optionality and better, matching those liability needs. The other, I guess, topic that comes up with investors that might not be as familiar with the securitized products markets is they often, refer to the global financial crisis, right? 2008.
Yeah.
And a lot of that was centered around the residential mortgage market, potentially some fraud that was going on in that space. But can you maybe talk about some of the changes that has taken place in the securitized markets post-GFC?
So there have been a number of changes, and it's going to vary depending on the industry you're in. So mortgages will have certain changes in terms of regulation, and then consumer-based assets will have also different changes. I will say if I kind of talk holistically about all of these sectors, I would say underwriting practices have become much more disciplined. So preceding the 2008 financial crisis, lending practices were very loose. Borrowers that didn't qualify were getting loans, or shouldn't have qualified were getting loans. But I would say those lending practices are much tighter today. And then on the liability side, liability and equity side, I should say, the structures are built much more resilient. So not only are there additional covenants in the form of certain interest coverage triggers and such to kind of protect the debt tranches, the tranches are also more insulated, meaning the equity tranche that we referred to in a couple examples, it's even thicker, meaning it takes a lot more losses to start impacting the debt. So I would say both the asset side and the liability and equity side are both safer coming out of the 2008 financial crisis.
And I think you see that in a lot of markets, right? Is leading up to the crisis, lending standards or other practices are very loose. And then if it impacts a particular market, the regulations on that asset class almost swing the other way, right? Where it becomes inherently maybe too strict. But at the end of the day, right, it's all about kind of investor protection and making sure that investors know what they own and not subject to what we saw in 2008.
That's right.
So Andrew, I thought this was very helpful. Thank you again for joining. I know you've given this presentation a lot. So I hope our viewers found this helpful. If you would like to learn more about DoubleLine's securitized strategies, please visit doubleline.com. And if you have any questions, please email info@doubleline.com. Thank you.